What is happening, crypto fam? Get ready, because the news cycle is moving at lightning speed, and if you're not plugged in, you're missing out. Today, we've got a packed show with updates that could shift the entire market. From mind-blowing future price predictions that have everyone talking to sudden market dips that have traders on edge, we're diving deep into what truly matters. We've got the data, the analysis, and the hype you need to stay ahead. So buckle up, because this is Bitcoin Bulletin, and you're about to get the unmissable updates you've been waiting for. First up, the future of Bitcoin looks incredibly bright, with some major players forecasting a price target that sounds almost unbelievable, driven by a perfect storm of institutional demand and shrinking supply. Is this the new normal, or just a temporary surge? We've got the details that explain exactly why this is happening and what it means for your portfolio. Then, we're talking about a sudden, sharp pullback that has sent shockwaves through the market. Was that 12% drop a strategic buying opportunity or a serious warning sign that the party might be over? We'll break down the forces behind this violent repricing and what it means for Bitcoin, Ethereum, and XRP. And finally, we're asking the big question: where is Bitcoin's bull run headed next? With predictions ranging wildly and the market showing signs of maturing, we'll explore whether we're at the climax or facing unexpected pitfalls. All this and more on Bitcoin Bulletin. Don't forget to smash that like button, subscribe, and ring that notification bell so you never miss an update. The $1.3 million Bitcoin forecast, a perfect storm ahead. Get ready for a future where Bitcoin isn't just a digital asset, but a cornerstone of global finance, with projections reaching an astounding $1.3 million by 2035. This isn't a fringe prediction. It's coming from Bitwise, a firm that sees a perfect storm brewing, driven by an unprecedented wave of institutional demand colliding with Bitcoin's famously constrained supply. Imagine a scenario where major corporations are not just holding Bitcoin, but actively increasing their stakes, with corporate holdings surging by a remarkable 35% in just the second quarter of 2025. Companies are accumulating Bitcoin at an accelerated pace, with a significant portion of the total supply, a staggering 70%, remaining untouched for over a year, signaling a strong conviction from long-term holders. This scarcity, coupled with daily miner production that's dwarfed by institutional withdrawals, is creating an imbalance that could fuel significant price appreciation. Adding fuel to the fire, Bitcoin's volatility has plummeted to historically low levels, with annualized volatility dropping from nearly 60% to around 30%. This newfound stability, partly attributed to the successful launch of spot Bitcoin ETFs in the US, is transforming Bitcoin into a more attractive store of value, akin to digital gold. Analysts are pointing to this reduced volatility as a key indicator of market maturation, making it a more appealing asset for conservative institutional investors and long-term wealth preservation. However, the road ahead isn't without its potential bumps. Some analysts are sounding a note of caution, warning of possible 65% price corrections. This risk is tied to the Federal Reserve's liquidity conditions, with concerns that a contraction in Fed cash reserves, similar to what was seen in 2022, could trigger significant market downturns. Recent ETF outflows, potentially driven by retail investors adjusting their portfolios amid tightening monetary policy, also hint at underlying market sensitivities. Despite these short-term risks, the overarching narrative remains bullish, with the convergence of inelastic supply, growing institutional adoption, and macroeconomic pressures creating what many believe is a perfect storm for Bitcoin's long-term ascent. The trajectory is increasingly shaped by institutional forces, but the market's sensitivity to liquidity and broader economic conditions cannot be ignored. But is this stability a sign of maturity or a prelude to a dramatic shift? Stay tuned, because the market is reacting, and we're about to see if Bitcoin's consolidation is setting the stage for its next major leap. Bitcoin's 12% plunge: buy the dip or brace for impact. In a sudden and dramatic turn of events, Bitcoin has experienced a sharp 12% pullback from its recent highs, leaving many investors questioning whether this dip represents a golden buying opportunity or a stark warning sign of further declines. The market, which had been riding a wave of optimism, saw Bitcoin's price plummet towards $109,000 after touching an all-time peak of over $124,000 earlier this month. This sharp correction has not only impacted Bitcoin, but has also sent ripples across the broader crypto market, wiping out nearly $200 billion in value from cryptocurrencies like Ethereum and XRP. The sentiment on the ground suggests that the rally might be losing steam, fueling growing fears of a more widespread crypto crash. The current market movements are deeply intertwined with traditional risk asset behavior and heavily influenced by monetary policy expectations. According to Thomas Chen, CEO of institutional Bitcoin software developer function, any deviation from the anticipated Federal Reserve's monetary policy, particularly regarding interest rate decisions, could trigger a violent repricing across major crypto assets. The market has been largely pricing in a September interest rate cut, anticipating a flood of liquidity that would typically boost risk assets like cryptocurrencies. However, if the Fed decides against a cut or delays its decision, it could lead to a significant correction. Chen warns that the current market structure might be built on a house of cards of a single narrative, a soft landing, and a shift in that narrative could result in a cascade of forced selling, potentially separating speculative positions from genuine institutional investments. All eyes are now on the upcoming inflation data, specifically the core PCE price index, which is a key indicator for the Federal Reserve's policy decisions. Consensus forecasts suggest inflation might remain steady at 0.3% month-on-month for July. Russ Mould, investment director at AJ Bell, highlights that this data, alongside jobs reports, will be crucial in determining the Fed's stance on interest rates. The market is currently pricing in an 85% chance of a 25 basis point cut in September, a scenario that has underpinned the recent bullish sentiment. However, any data that contradicts this expectation could quickly reverse market fortunes. This pullback serves as a critical reminder of the inherent volatility and sensitivity of the cryptocurrency market to macroeconomic factors. While some see the dip as a chance to acquire Bitcoin at a lower price, others are bracing for further downside, especially if the Federal Reserve's actions diverge from market expectations. The ability of the market to absorb this selling pressure and the reaction to upcoming economic data will be key determinants of Bitcoin's short to medium-term trajectory. Could this sharp correction be the catalyst for a new wave of innovation, or is it a sign of deeper systemic issues at play? We'll explore the potential impact next. Bitcoin's bull run crossroads, maturation or impending correction. As Bitcoin's current bull cycle inches closer to what analysts are calling a significant climax, a palpable sense of contemplation has settled over investors worldwide. This thrilling juncture, marked by increasing institutional support and evolving liquidity dynamics, presents a complex landscape where major breakthroughs seem possible, yet potential pitfalls loom large. Historically, Bitcoin bull cycles have been known to span anywhere from 350 to 1,000 days, but emerging insights suggest a potential shift in this pattern. Crypto analysts, including Egrag Crypto, are forecasting a possible slowdown in growth momentum, projecting a ceiling of just 27% before the current cycle concludes by December 2025. This doesn't necessarily signal a bear market, but rather a sign of a maturing market, where the increasing influence of institutional investors is becoming a dominant factor, inevitably leading to market corrections. Projections for Bitcoin's value by late 2025 are painting a wide spectrum, with estimates oscillating between an optimistic $150,000 and a more aggressive $280,000. This bullish sentiment is significantly fueled by the heightened institutional activity, evidenced by substantial over-the-counter transactions and shifts in liquidity patterns. As these institutional players solidify their positions, the scarcity of Bitcoin could either propel prices to new heights or create vulnerabilities. An unexpected sell-off from a major holder could potentially trigger a rapid price drop, pushing Bitcoin back into the $90,000 to $100,000 range. The traditional 4-year price cycles, once a reliable predictor, are now being challenged by the consistent and strategic interests of institutional investors, indicating a less predictable path forward. Amidst the prevailing optimism, a cautious undertone persists within the investor community. As Bitcoin approaches what might be its cycle peak, the possibility of market corrections becomes a more pressing concern. Current analyses suggest that we might be witnessing the final stages of this bull cycle, with estimates indicating around 93% completion. This reality underscores the imperative for finely tuned investment strategies. While the temptation for quick profit-taking is strong, it could inadvertently trigger swift corrections, highlighting the need for robust trading plans to navigate these potentially turbulent waters. Experts continue to advocate for a long-term holding strategy, emphasizing that Bitcoin's underlying value is intrinsically linked to its diminishing availability and its potential as an inflation hedge. As more investors embrace a long-term perspective, the focus shifts from chasing fleeting gains to preserving capital, steering clear of high-risk, short-term plays. The rapid pace of innovation in Bitcoin and blockchain technology is also sparking polarizing responses, particularly within the regulatory sphere. This creates a dichotomy. Prolonged growth phases might signal market maturation, but they could also inadvertently stifle the creativity and agility of nascent Web3 startups that are navigating complex regulatory landscapes. For these entities, seamlessly integrating fiat and cryptocurrency transactions will be paramount to establishing a competitive edge in this rapidly evolving financial ecosystem. So, are we on the cusp of unprecedented growth, or is this the calm before a storm? Stick around as we break down what's next. Market turmoil. Bitcoin plummets amid Fed policy fears, Ethereum and XRP hit hard. Bitcoin has experienced a significant and sudden downturn, shedding 12% from its recent peak and hitting its lowest level since early July. This sharp decline has sent shockwaves across the crypto market, with Ethereum, XRP, and other major cryptocurrencies also facing substantial losses, collectively wiping out nearly $200 billion in value. The price drop has intensified fears of a broader crypto crash, as traders begin to question the sustainability of the recent rally. The market's reaction appears to be closely tied to expectations surrounding Federal Reserve monetary policy, with any deviation from the anticipated rate cuts potentially triggering a violent repricing across digital assets. Thomas Chen, CEO of institutional Bitcoin software developer function, highlighted that much of the recent price action is linked to the expectation of liquidity flooding the market due to anticipated Fed rate cuts. He warns that if the Federal Reserve deviates from this script, especially in September, it could lead to a large correction. Chen likens the current market structure to a house of cards built on the narrative of a soft landing, suggesting that a failure to meet these expectations could result in a cascade of forced selling. This could potentially distinguish between speculative crypto positions and more robust institutional deployments of Bitcoin and Ethereum. The market's focus is intensely fixed on upcoming economic data, particularly the core PCE price index, which is the Federal Reserve's preferred inflation gauge. With consensus forecasts predicting inflation to remain steady at 0.3% month-on-month for July, the data will play a crucial role in shaping the Fed's decision on interest rates. Market participants are currently pricing in a high probability of a 25 basis point rate cut in September, a scenario that has fueled the recent bullish sentiment. However, any indication that the Fed might hold off on cuts or reduce the expected magnitude of cuts could trigger significant sell-offs. This period of volatility underscores the crypto market's sensitivity to macroeconomic factors and central bank policies. While some investors may view the pullback as a buying opportunity, the underlying risks associated with potential Fed policy shifts and the possibility of forced selling due to leveraged positions cannot be ignored. The immediate future of Bitcoin and other cryptocurrencies will likely depend on the upcoming economic data releases and the Federal Reserve's subsequent policy decisions. The market is at a critical juncture, where sentiment can shift rapidly based on these external factors. But what does this mean for the long-term trajectory of Bitcoin and the broader digital asset space? We're about to find out. All right, crypto crew, that's a wrap on today's essential updates. We saw predictions of Bitcoin hitting $1.3 million, a sharp 12% pullback sparking debate, and a deep dive into where this bull run is headed. Stay informed, stay invested, and most importantly, stay safe out there. If you found this valuable, do us a solid. Smash that like button, subscribe to Bitcoin Bulletin for more critical insights, and hit that notification bell so you never miss a beat. Also, follow us on all our social channels for real-time updates and join the conversation in the comments below. We'll see you in the next one.